Dear traders, there is one number sitting on the screen right now that will decide whether you get trapped chasing this euro rally or whether you get the single best risk-reward entry of the week. That number is 1.1786. And most traders watching the charts right now are completely misreading the structure. I'm looking at a euro that has held a bullish daily trend, a 5-hour trend still pointing higher, and a headline that literally says the pullback could offer better entry levels. But here is the problem. When the market hands you an obvious headline and an obvious trend, it is usually setting the perfect trap. So right now I'm going to walk you through the exact technical architecture, the hidden divergence that nobody is talking about, the bond spread fracture between the ECB and the Federal Reserve, and then I'm giving you 3 exact trade strategies: conservative, standard, aggressive, entry, stop, targets, invalidation, everything mapped to the pip. Stay until the end, because the aggressor play on a breakout above 1.1801 is something most traders will be too slow to see, but it is the highest reward to risk setup on the board today. Let's cut straight to the instant market verdict. The session bias right now is trending but exhausted. That sounds contradictory, so let me make it precise. The daily trend is bullish, price is above the 20-day, 60-day, and 200-day moving averages, and the sequence of higher highs and higher lows is intact. But the 4-hour chart is flashing. An exhaustion signal that I have seen kill rallies many times before. My bias for today's London and New York overlap is a fade the spike and buy the dip structure. I am not chasing above 1.1786 until we get a confirmed hourly close above there with volume, and I will tell you what confirms it later. If we stay below 1.1786, this is a range topping trap and the pullback towards 1.1738 is live. The one invalidation level that flips this whole thesis bearish is 1.1729. That is the line in the sand. Write this number down. If we break and close below 1.1729 on the 4-hour chart, the entire bullish structure is compromised, and we are likely heading for a deep washout to the 1.1650 region, which is where the 200-period moving average on the 4-hour sits. That's the conversation we need to have right now. So interaction number 1. Type in the comments right now the one word, trap or breakout, and in the next few minutes I'm going to give you the exact technical reasons that reveal which side is more probable. I'm reading the comments live after the session, so get your bias down. Now let's go deep into the technicals, and I want you to visualize the chart with me. Start from the top. The weekly time frame. The weekly chart on euro to US dollar shows price finally recapturing the 60-week moving average near 1.1550 after months of compression. The weekly MACD is in a bullish crossover, histogram bars are expanding, and every pullback over the last 3 weeks has been bought near the 20-week moving average. That is the macro foundation. The long-term bias is bullish and the 200-week moving average way down at 1.1400 is not even in play. That tells you the big money is positioned for a grind higher into ECB tightening narrative and US terminal rate exhaustion. Now drop to the daily chart. The daily moving averages are beautifully stacked. The 20-day moving average is at 1.1720 and it is acting as dynamic support. The 60-day average is down at 1.1550 and the 200-day is at 1.1400. The daily MACD is printing higher highs, but here is the subtle warning. The histogram on the daily has started to lose momentum relative to the price rise over the last 3 candles. It is not a divergence yet, but the rate of change is decelerating. That subtle flattening is often the first whisper that a pullback is near. Now drop into the 4-hour chart. This is where the tension lives. On the 4-hour, price is above the 20, 60, and 200 moving averages. The 4H200 MA is currently at 1.1600, the 60 MA at 1.1700, and the 20 MA at 1.1750. The current print at 1.1780 is wrestling with the key resistance cluster between 1.1786 and 1.1801. And if you look at the 4-hour MACD, I see a clear negative divergence. Price made a higher high into this zone, but the MACD histogram made a lower high. Buyers are exhausted. That negative divergence on the 4-hour timeframe tells me that momentum is stalling, and the probability that we slice through 1.1786 without a pullback first is low. If you are trying to long right here without seeing the dip, you are buying into exhaustion. The market will likely need to refuel. The 1-hour chart adds the final layer. The 60-minute moving averages show the 20 period at 1.1770, the 60 period at 1.1760, and the 200 period at 1.1740. Price is hugging the 20 period, which is flattening. The 1-hour MACD has already crossed bearish and is pointing lower. That is your short-term trigger for the pullback scenario. So the roadmap is clear. Support at 1.1738 is the first demand zone, and just below at the structural floor at 1.1729 aligns with the daily 20 MA and the 60-minute 200 MA. That is the zone whereby orders are waiting. Above us, 1.1786 is the immediate trigger. A clean 1-hour close above that opens the door to 1.1801, and then beyond that, there's a liquidity void that could accelerate price toward 1.1850. So today's technical architecture is a bullish daily trend colliding with a 4-hour exhaustion signal, and the 1-hour chart is the referee. That's where the trap lives. And now I want to link in one of the dollar killer sidekicks, pound sterling to US dollar. Pound dollar is printing a similar structure near its own resistance, and the policy differential between the Bank of England and the ECB is widening. The market is starting to price a hawkish hold from the Bank of England, while the ECB hawkishness is getting fully priced in. This relative policy gap is creating a subtle rotation into sterling and out of euro on the crosses, which is adding friction to eurodollar's upside. That's a crosslink you need to watch. If euro to pound sterling starts breaking lower while cable holds, dollar selling could be funneled more into pound than into euro, and that will create a relative underperformance in euro to US dollar, limiting the breakout velocity. That's the kind of narrative threading most retail traders completely ignore, but it is exactly what institutional desks are analyzing right now. Let's layer the fundamental driver. The 24-hour headline says it plainly. Euro to US dollar holds bullish bias, but pullback could offer better entry levels. That sentence is a wonderful summary of the fundamental tension. The European Central Bank hawks continue to talk up the terminal rate, and recent inflation stickiness in core services is keeping the ECB firmly in tightening mode. Meanwhile, the US dollar is suffering from a narrative shift, where the market now believes the Federal Reserve is closer to pausing than re-accelerating. Real yield differentials between German bonds and US Treasuries have compressed, and that has been the primary engine for this euro rally. But here is what changed in the last 24 hours. We had a subtle bid for the dollar during the Asia session due to a risk-off pulse from Chinese data, and some safe haven flows into the yen and dollar. That's where the cross-asset narrative with US dollar to Japanese yen and Nikkei 225 becomes crucial. If Nikkei futures are struggling and dollar yen is testing intervention fears near 145, the dollar gets a temporary haven bid that weighs on euro dollar. That's the reason you're seeing a stall at 1.1786 today. The pullback is being engineered by this transient risk-off repricing. But the core fundamental lean for the next 1 to 2 weeks remains bullish for euro to US dollar. The ECB is not pivoting, the Fed is priced for a pause, and the dollar smile theory is tilting toward a weaker dollar as global risk appetite stabilizes. The event that would completely invalidate this thesis is a hot US core PCE print or a surprisingly dovish ECB minutes that reveals internal dissent. Without that, any dip toward the support zone is a buy in the medium term. Also check gold in this context. Gold as the fear architect has been coiling just below trend resistance. If gold breaks out on real yield compression, it confirms the dollar weakness narrative and will drag eurodollar higher in sympathy. So your gold chart is a leading indicator right now for the euro to US dollar trajectory. When gold moves, the euro follows with a lag. It's a powerful confirmation tool. Now, most people will click away right here. But this is where money is made. Keep watching. I'm going to hand you 3 fully structured trade setups. Exact triggers, exact stops, exact targets, and the risk-reward logic behind each one. Print this part, screenshot it, whatever you need. But do not trade without a plan. Strategy 1, the sniper. This is the conservative, high probability setup for those who want to wait for the market to prove itself. The trigger condition is a pullback into the support zone between 1.1738 and 1.1729, followed by a bullish rejection candle on the 1-hour chart. Specifically, I want to see a 1-hour candle that wicks below 1.1738 but closes back above it, ideally with a bullish engulfing or a long lower shadow. That is your signal that buy orders are absorbing the sell pressure. Entry is on the next candle after that confirmation, placing a buy stop at 1.1745. Your stop loss goes at 1.1720, which is below the structural floor and the 60-minute 200 MA to give it room, but not enough to kill the risk-reward. That's 25 pips of risk. Target 1 sits at 1.1780, the current resistance pivot, for a 35 pip gain, a 1.4 to 1 reward-to-risk ratio. Target 2 sits at 1.1800, right below the major resistance cluster, adding a 55 pip gain and a 2.2 to 1 ratio. If price breaks below 1.1720 with conviction, the setup voids and you step aside. The sniper waits for the pullback, waits for the signal, and fires. No gambling. Strategy 2, the active trader. This is for the trader who is comfortable entering on a moving average bounce with a clear invalidation. The entry condition here is a test of the 60-minute 200 period moving average, currently at 1.1740. We know the 200 MA is an institutional magnet. When price retests that level and the 1-hour RSI is around 40 with a bullish MACD bend, that's the re-entry spot. So you place a limit order to buy at 1.1740. Stop loss goes at 1.1718, just below the sniper's invalidation, giving it 22 pips of room. The logic is that if 1.1740 fails, the structure has changed. Target 1 is again 1.1780, a 40 pip gain. Once target 1 is hit, move your stop to break even immediately, and let the rest run to target 2 at 1.1800. If momentum is strong, you can transition to a trailing stop of 20 pips behind price once we are above 1.1786. This way, you capture a potential breakout without giving back profit. The risk-reward on this initially is close to 1.8 to 1 on target 1, and over 2.7 to 1 on target 2. The active trader setup is about precision around that moving average, and it captures the pullback that the headline is hinting at now, interaction cliff. Let's see how aligned we really are. Type your euro to US dollar range for tomorrow in the comments right now. Give me a high and a low. I'm reading them. I want to see if you're seeing the same liquidity boundaries I am. Strategy 3, the aggressor. This is the high-risk, counter-exhaustion breakout play. Only for those who understand how to lose small and manage risk aggressively. The entry condition is a 1-hour candle close above 1.1786 with a wick that does not exceed 30% of the candle body. That shows a clean, decisive break. If that prints, you enter long immediately at market, no waiting. Stop loss is tight at 1.1765, just below the breakdown of the resistance and below the 1-hour 20 MA. That's a 21 pip risk. Target 1 is 1.1801, a quick 15 pip scalp that captures the immediate liquidity gap. But the bigger prize is target 2 at 1.1850, the next psychological and structural barrier, giving around 64 pips of potential gain. That is a 3-2-1 reward to risk. The invalidation is a rapid reversal back below 1.1786 that traps breakout traders. If you see the candle close below 1.1786 after entry, you exit instantly, no questions. This aggressor setup only triggers on breakout confirmation, not before. That's the difference between catching a move and being trapped. The danger is a false breakout, which is why the stop is tight and the patience for the candle close is mandatory. Risk management pulse. Never risk more than 1 to 2% per trade. No positions through high-impact US session news like ISM or FOMC speakers that can whip the dollar. Stops are non-negotiable. Now let's close this out with the number that matters most for the next session. The level is 1.1729. If that level holds, the bullish architecture is alive and every dip is a buying opportunity that aligns with the fundamental ECB Fed divergence. If that level breaks and closes on the 4-hour, the dollar killers take a hit, and you need to step back and reassess for a deeper correction. Tomorrow we'll be laser-focused on the US durable goods data and any ECB speakers, because they will be the catalyst that either validates this pullback as a gift or starts a trend disintegration. And if you really want to understand how this euro setup fits into the bigger picture, the full breakdown on Bitcoin and the S&P 500 divergence is live right now. I explain the risk asset shadow dynamic, funding rates, and where the liquidity tide is heading. That video is linked on your screen. Hit it next. If this analysis gave you a crystal clear plan, smash the like button, subscribe, and ring the bell for daily coverage on 8 assets. I'll see you in the next one.